Welcome back to Around the Table with Stacy Smith. We've been talking about the rise in interest rates that are expected this week, how that's going to affect the economy, and whether indeed the interest rates rise by the Fed are going to really tamper down inflation. And that, I guess, is back to my question. The three of you have indicated that the economy is in really good shape. If the Fed continues to, I mean, is that basically all the Fed can do, is to raise interest rates to try to keep inflation down? If there's a job shortage, people are having no trouble finding a job, the wages are going up. I mean, it just sounds like it's all inflationary. How can they stop it?
Well, rates going up really is their main tool, the main tool that they use to head off inflation. I think that the concern really lies in the housing market, because the housing market is a leading indicator. And, if there's any concerns I have about next year, I do agree that right now the economy is strong, and the amount of cash that people have on the sidelines is still relatively high, but the direction of that cash has been going down. People have been tapping into their savings a little bit more. The savings rate has come down a bit. But when we look at housing and the dramatic shift that we have seen in the last few months, because we do have interest rates up over 7%, the highest in 20 years. We do have the monthly supply of homes that have almost doubled, which is a good thing because prices, we're still looking at prices that are still elevated. And in some regions of the country, like in San Francisco, where, you had astronomical price appreciation, we're starting to see prices come down pretty dramatically. But there is a multiplier effect on housing. So, you buy a house, you go to Home Depot every night for like 3 months. So there's concern that if the housing market slows, then that might slow some economic activity. When we look at corporate earnings, and we look at the cost of, capital, as interest rates go up, that slows investment, capital investment, because of interest rates. And, it's a fine line. You hear people talk all the time about, can the Fed achieve a soft landing? Meaning, can they raise rates to a point where you curb inflation, but you don't push the economy into recession?
Inflation in itself is not bad. The opposite of inflation is deflation. That leads to depression. We avoid deflation at all costs. The question about inflation is how much we're having inflation. We're going to continue to have inflation. We've always had inflation, but how much inflation? Because the economy grows with a relatively plannable level of inflation. If it's out of line, and it's nowhere near out of line right now, that's what the Fed is doing to try to dampen it down, get it down to that 3%, 4%, even 5% range, to where it can be assimilated into pricing, wages, and expenditures. And that looks as though it's slowly moving in that direction.
And to just put another counterpoint on the interest rate thing, which none of us, I think, have said up until now, 10,000 baby boomers a day are retiring. Up until 6 months ago, when they retired, they got on their savings less than 1%, which means they had to take risks that they probably shouldn't have been taking, trying to create a return on their capital. With these interest rates rising, there's ultimately about half of the baby boomers have retired at this point. Bob and I accepted, and you, Stacy, you tried, but you failed. And we can earn, without taking so much risk, a reasonable rate of return on our capital now as retired people, which means that their retirement is actually getting more stable, simply because the interest rates on money are better.
Right. And listen up, baby boomers. Don't retire yet. Keep working. We need you during this transition period where we build up the rest of the labor force, the skills of the labor force.
Is it the retiring of the baby boomers? One of the main, is that perhaps the main reason that we have a labor shortage right now? Then
I don't think so. I don't think that's it. I think we have a shortage of labor because of the new paradigm that, and I hate that phrase, but that we've created in work situation. And there are people who wish to remain working from home, and they're withholding their services unless they can find positions that allow them to do that. It's a reorienting right now that we're experiencing. Also, the folks that are at the lowest end, the wait staff in a restaurant, they're hard to find. And that's what we need to, this economy is working its way around to equilibrium in the labor force. We're not here yet. That's why don't retire baby boomers.
And it really is, even Stacy, to your point, in Pittsburgh, you know, we have a huge problem with the amount of people that will be retiring and the people that are not available to replace those jobs. So that has some influence. We also have a huge skills mismatch. Where people are not they are not necessarily at this point trained for the jobs of the future. So, you know, fortunately, at least at the college level, they're focused on that, but it takes some time. So it's all very interconnected.
I want to wrap up the segment about which Carrie got us into, and that's on housing. So, Frank and Bob, do you agree with Carrie that as the housing prices go up and fewer people are able to afford these homes, that this will bring down some of the higher inflation?
No one's repealed the law of supply and demand. There's no question. Nothing goes up indefinitely. So when you get to a point where people feel that they can't afford, and commensurately raising interest rates,
right,
which adds to the repayment factor of those homes, you're going to get a slowdown, and we're seeing it right now. That's a good thing. That's a good thing for now.
But on the flip side of that, because all these things are double-edged swords. 4 months ago, the people who try to figure this stuff out were saying we have a 4 million home shortage of homes in this country. I can't imagine that went away. And consequently, we still are going to have demand for housing. Now, whether it's in single family homes or apartments, that is how that will work out, slide back and forth between that. Nonetheless, rents are getting expensive as well. And what we have to consider is that the expectation of the quote McMansion maybe has to get dialed down a little bit so that people can afford, so they can live in what they can afford to live in rather than what they want to live in.
And that's happened in previous cycles of the real estate cycle. Frank, I would argue that you're right, but in that short 4-month period, demand has diminished for the factors we discussed. Some people are saying we'll stay in this house for a while until things stabilize. We were going to look for another home, but we're not. So the demand level's gone down in that quick a period of time because of the interest rate bump.
But I have yet to see anyone say that the shortage of homes has diminished at all. It may have. I just haven't seen anybody I'm not capable of figuring that out. Whoever's capable of figuring it out, I'd like them to tell me what it is now.
Quick differentiation before Stacy goes to a break. Two phases to it. There's resale of existing homes and building of new homes. The new homes that's dropped quite a bit, and the resale of existing homes has slowed. So yes, the demand is still there, but those factors are two intertwined pieces.
All right, Bob, you just said we have to take a break, and indeed we do. We'll be back in just a moment.